Thank you. Thanks, Teresa. I'll be making some forward-looking statements, so I encourage you to read those on our website. It's the second day of the conference, and I think having had a couple of beers last night and talking to a lot of people, and I'm sure you all have heard, everybody's undervalued. And indeed they are, and so are we. So when everybody's looking for new money, new investors, and there's limited funds, what you really have to look at is how you deploy or where do you deploy that. And you got to look at companies that can meet your investment criteria. I think one of the first investment criteria should be the location. Our properties are in Quebec. Quebec is one of the most sought-after jurisdictions in terms of infrastructure, government support, and rule of law for mining development. But I think the second one would be a trusted geology, a trusted location, and this is in Abitibi. Our properties are in the northern Abitibi, along the Sunday Lake Deformation Zone, where really the D2 Lake mine is on the Ontario border, as well as Wallbridge, owning roughly about 830 square kilometers, 97 kilometer stretch of the land along this belt. More importantly is the two gold systems that we've so far identified, one at Fenelon with about 4.1 million ounces, about 60% of that in the indicated category, and about 1.3 million ounces at Martiniere, which is 30 kilometers away from Fenelon, also about 60% in the indicated category. I think when you really look at the project, we purchased this small little postage stamp of about 1,000 hectares from a company called Balmoral Resources in late 2016. Throughout 2017 and 2018, we continued to expand that original 40,000-ounce ultra-high-grade deposit and expanded that. We're successful. Late 2018, we decided to turn the drill around because everybody was drilling from south to north, looking for the extensions of that Gabbro zone. Our guys turned the drill around and said, we want to test this magnetic low. I'm not a geologist, but apparently magnetic lows are good. So sure enough, throughout that Christmas holidays, we continued drilling, and we were over 200 and some odd meters into mineralization. Coming back from the Christmas holidays, we followed up on that, found the Tabasco Cayenne zones, which I believe the first or second hole was 22 meters of 48 grams a ton. So essentially, that was our new discovery in 2019. During 2019, we continued following that up. Our currency got valued enough that we decided that if this deposit continues to grow, the property owner outside is Balmoral Resources, and at the time, it was a good time for us to approach Balmoral to acquire that company. We acquired Balmoral Resources in mid-2020, and as a result, we now own this large district-scale land package with the two large gold systems and a prospective land package in terms of exploration, because of the 25, 30 meters of overburden, really exploration didn't really start till the late 80s, early 90s, as opposed to the southern Abitibi where you could kick the moss and find gold in the 1900s. So although it's been a challenge, we find that as an opportunity for us to find new discoveries on this land package. We also wanted to focus on gold. Acquisition of Balmoral also gave us a 5.5 million ton nickel deposit at 1.6% nickel, as well as our own assets in Sudbury, Ontario, with the base metal assets, that we sold that to a company called Archer Exploration last year, became the largest shareholder of Archer, and gave most of those shares back as a return of capital to our shareholders, but we still maintain a 19.9% holdings in Archer, as well as a 2% royalty. Now, obviously, those who are already shareholders of Wallbridge and also own Archer, they're probably not very pleased with the share price of Archer as it is when, compared to when we spun it out. But I'll tell you, we were the founders of Duluth Metals. We had our Minnesota properties, spun it out into Duluth. Duluth went into a joint venture with Antofagasta. After the financial crash, they went to 7.5 cents from 60 or some odd cents. For every 4 Wallbridge shares, we gave 1 share of Duluth. Duluth went up to be $4, so essentially we gave $1 dividend to our shareholders. We're hoping we can repeat that success, but again, we just didn't want to be distracted with base metal as well as gold, so we wanted to focus on gold exploration. We came up with an updated mineral resource estimate at our Fenelon deposit, as well as an updated mineral resource estimate at Martiniere this January. And it's, again, as I mentioned, it's together about 5.4 million ounces, gold endowment, with about 60% of that in the indicated category. We know Martiniere could potentially be our next multi-million ounce deposit, but for now we decided that we bring the Fenelon into an economic study because it was at a stage where we wanted to draw that line in the sand in terms of telling the market what sort of, at least give the market a bit of evaluation. So we completed this preliminary economic assessment in June of this year. It's about a 7,000 ton a day operation, over 200,000 ounces of annual gold production, over about a 12.5-year mine life, about a $720 million NPV, and I'll give a bit more detail on that. And we've done all of this with good ESG principles in mind. One of the key things that we're very proud of is our relationship that we've built with the First Nation communities. Today, close to 25 to 30% of our workforce is made up of First Nation communities, and we've supported local initiatives, including giving a $1.5 million investment to a road improvement that will allow us to be able to utilize the supply chain from the nearest town of Matagami. In terms of shareholding, Eric Sprott, as he's typically involved in a lot of gold mining companies, he's a 17.5% shareholder of Wallbridge. Agnico Eagle, as a result of the acquisition of Kirkland Lake Gold, currently owns 9.9% of the company, and over the past few financings that we've completed, they've already committed to their pro rata up to the 9.9%. And the balance of that is in the retail, and within the retail, there's about a half a dozen groups that each individually own 20 to 30 million shares. So we have supportive shareholders who understand the value of the company, and we're hoping that in the future, if there is an activity, that we'd be able to defend ourselves against anything that we don't believe is valuable for us. In terms of cash, today we have about $30 million Canadian in the treasury. We have a pretty large program this year. It's a $33 million program. We're going to end this year with about $17 million. We might do a small flow-through financing as we are in Quebec, maybe $5-10 million before the end of the year. So we know that next year we're going to be starting with about $27-28 million going into next year. We certainly want to continue advancing the project, but as we go through the requirements for the Fenelon's advancement, at a market cap of $140 million today, we certainly aren't going to be the ones who are going to bring Fenelon to production. Our focus right now is to evaluate alternatives in order to be able to advance Fenelon. But while we do that, we certainly see a lot of potential for us to continue to demonstrate the size potential of our existing deposits at Fenelon and Martiniere, and also do regional exploration, potentially in finding a new discovery. That I'll go a bit into that as well. So, in terms of the mineral resource estimate, the Fenelon mineral resource was really based on the drilling that we had done down to about 1,000 meters. The PEA is based on the back of that mineral resource estimate of about 4.1 million ounces. About last year, we decided to drill one hole down to 1,500 meters. Deposits in Abitibi don't stop at 1,000, but we certainly didn't want to focus all of our resources on trying to expand that at depth, especially from surface. But we drilled this 1,500-meter hole. We reached similar type of mineralization, similar geology, and still 4 meters of 17 grams a ton. Demonstrated to the market that this deposit continues to grow, but there was enough lateral expansion potential at Fenelon for us that we designed our exploration program this year to really look at the potential growth of Fenelon, not incrementally. We're not interested in trying to increase the 4.1 million to 4.6. We actually are doing 200-300-meter step-outs, in fact, going somewhere around 1 kilometer to 2 kilometers from the existing resource, looking for the new satellite deposits, because we believe that the hub and spoke will work along this entire land package. Fenelon today has already demonstrated a pretty good economic study, over 200,000 ounces, over 12.5 per year, over a 12.5-year mine life, about $160 million free cash flow annually. And this is just a good starting point from our point of view. Any satellite discovery, whether it's at Martiniere at 1.3 million ounces today or potentially more, or another discovery nearby, whether it's 200,000 ounces or 2 million ounces, will certainly just improve the economics of the current deposit at Fenelon. In terms of production profile, as I mentioned, it obviously varies. The grade will vary. But I think what's more important about this is maybe talk about the metallurgy on this. The deposit's got a very simple metallurgy. It's free gold, essentially. 66.5% of the Tabasco Cayenne zones are recoverable in the gravity. 85% of the Area 51 zones are recoverable in gravity. And overall, we actually have about a 97% discovery. There was one sample that was 95 out of the 9. We decided to use the 96, which is not the average, but actually what our consultants believe. That's what was used in the PEA. In terms of the CapEx, it's about $645 million. The way we looked at it, we currently have an underground infrastructure already that goes down to 200 meters. Last year, we actually enlarged the existing underground ramps to 5.7 by 5.5 meters. So that way, it allows us to be able to actually start the commercial production in the first 3-4 years from the ramp access in the upper parts of the deposit, and then start the shaft sinking in the second year of commercial production. So by the end of the 4th year, we'll be able to actually utilize the shaft in order to be able to continue the mining of the deposit. So that's why you see the sustaining CapEx includes the shaft construction. We did talk about the cash flow, and in terms of the sensitivity, we've even used the up to plus 20% in the capital costs and operating costs, and it's still respectable net present values for the project. One thing I wanted to mention, and I know that it's cliche because everybody thinks that their project was more detailed than the others, but I used to be a QP on a lot of projects. I used to own a consulting company, worked for various mining companies, junior and majors. And one of the key things that we realized that in the past, most of the PEAs will actually look at an average of last few deposits or prorate something that was 10,000 to 7,000. Well, we all know that between 2020 and 2023, costs have escalated quite substantially. So one of the key things we did is we asked the consultants, do not average. We want you to go to the suppliers, get prices from the Metso, from Outokumpu, Automation. Mining contractors need to give you the prices. And those are the prices we've included in our operating cost. More importantly, at the end of it, we actually wanted to do a sanity check against the existing operation. So we approached 2 mining companies that have similar projects, bulk mineable deposits, asked them if they could review our operating costs to see if it makes sense. So they came back with a couple of suggestions that we actually incorporated into this PEA. So we believe our current PEA utilizes the OPEX costs of Q4 2022, because the discussions that we had was in the first quarter of 2023. Now, one of the questions that I've been asked over the past 2 days is, can you make money out of a sub 3 gram per ton deposit? Well, it's a function of the deposit itself. If it was a narrow vein mining, no. But in the bulk mineable scenario, certainly possible. Some of the analogs to Fenelon would be the Young-Davidson of Alamos. Potentially Goldex, but Goldex is looking at it differently from a point of view of a larger stope. But the average size of a stope for Fenelon is about 20,000 tons. Young-Davidson average, before they did the expansion below in the deeper part, they actually were about 21 to 22,000 tons per day. Correct me if I'm wrong, but these are the numbers that I've been given. So when I looked at the Q1 2023 production statistics from these companies, public information, today, Young-Davidson in first quarter did 2.34 grams a ton at an all-in sustaining cost of $1,133. Goldex at 1.7 had a sub $1,000 US per all-in sustaining cost, and Fenelon's PEA is at $924 per ounce, US per ounce. And the reason for that actually is a fewfold. Number one is the fact that the grade of the deposit is higher than the other deposits that I mentioned. But more importantly, for example, when you compare that to Young-Davidson, energy costs in Ontario is about 12.5 to 13 cents a kilowatt hour. In Quebec is 5.5 cents. That's a very big factor in terms of your processing costs. More importantly, the gravity recoverable type of a deposit that we have at Fenelon helps in terms of reducing your reagent costs and everything else. So those are the reasons we believe this PEA is quite close to what reality is, at least today. Obviously, it's still a PEA level. There's still more work needs to be done in terms of geotechnical to be able to improve perhaps on the stope sizes. In terms of metallurgy, we also want to make sure how we're going to be able to maybe capitalize on some of the sulfides that are there, because most of the gold is associated with chalcopyrites. So essentially, the next one is Martiniere. Martiniere has only been drilled down to about 400 meters. Quite a lot of potential for us to be able to grow that. So as a result, this year's program continued to do the exploration around those existing deposits. And basically, that's it.
You're out of time.
I ran out
Thanks
of time.
a lot, Marz. Yeah,
Thank you.
thanks for the update.
Okay.